The financial world watched with bated breath. The latest Consumer Price Index (CPI) report had just dropped. The numbers were in. Inflation, the silent thief of economic stability, was still wreaking havoc. Experts had predicted a slight cooling. They were wrong. Yet something unexpected happened. The market didn't flinch. It was a scene of eerie tranquility. The S&P 500, a bellwether for market sentiment, barely budged. The Dow Jones Industrial Average, a historical titan, remained unfazed. What was going on? This was no ordinary day on Wall Street. The market, it seemed, was playing a high-stakes game of chicken with economic reality. Were investors oblivious to the danger, or did they know something the rest of us didn't? The CPI report painted a stark picture, revealing the complexities and challenges that lie ahead for the economy. Inflation, though slightly lower than previous months, was more persistent than anticipated. This persistence suggests that the forces driving inflation are deeply rooted and not easily swayed by short-term measures. The headline number, a broad measure of price increases, came in at a worrying 0.4% for April, exceeding the 0.3% forecast. This deviation from expectations has significant implications for economic policy and consumer confidence. Core CPI, which strips out volatile food and energy prices, told a similar story. By focusing on the core components, we get a clearer picture of the underlying inflationary pressures that are not influenced by temporary shocks. It rose by 0.5%, outpacing the 0.4% estimate. This consistent rise in core CPI indicates that inflationary pressures are broad-based and not confined to a few sectors. This indicated that inflation wasn't just a result of temporary supply chain disruptions or geopolitical turmoil. Instead, it pointed to more systemic issues within the economy that need to be addressed. It was becoming entrenched in the economy, a worrying sign for consumers and policymakers alike. The entrenchment of inflation means that it could take longer and require more aggressive measures to bring it under control. The cost of everyday goods continued to climb. From groceries to household items, consumers are feeling the pinch as their purchasing power diminishes. Gasoline prices, while off their peak, remained elevated. This sustained high cost of fuel has a ripple effect, increasing transportation costs and, consequently, the prices of goods and services. Groceries were putting a strain on household budgets. Families are finding it increasingly difficult to make ends meet as the prices of essential items continue to rise. Even the cost of a simple cup of coffee had become a luxury for some. This highlights how pervasive inflation has become, affecting even the smallest aspects of daily life. The data was clear. Inflation was far from tamed. Despite various efforts to control it, the numbers indicate that more robust and perhaps unconventional measures might be necessary. Yet, the market remained eerily calm. This calmness could be a sign of confidence in future policy measures or a dangerous complacency that ignores the underlying issues. It was time to unravel this mystery. Understanding the root causes of this persistent inflation is crucial for developing effective strategies to combat it and restore economic stability. At the heart of this enigma lay the Federal Reserve, the guardian of the U.S. economy. Tasked with maintaining price stability and maximizing employment, the Fed had been walking a tightrope for months. To combat soaring inflation, the Fed had embarked on an aggressive campaign of interest rate hikes. These hikes, intended to cool down the economy by making borrowing more expensive, had been the most rapid in decades. The strategy, however, came with risks. Raise rates too quickly, and the economy could screech to a halt, potentially triggering a recession. Move too slowly, and inflation could become further embedded, leading to a wage price spiral and prolonged economic pain. The Fed was in a bind, caught between a rock and a hard place. The market's muted reaction to the CPI report seemed to defy logic. Investors and analysts alike were left scratching their heads trying to make sense of the unexpected calm. Higher inflation typically spooks investors. It sends shockwaves through the market, causing panic and sell-offs. It erodes the value of future earnings, making stocks less attractive. Companies' profit margins get squeezed, and the cost of borrowing rises, creating a challenging environment for growth. Yet here we were, witnessing a display of remarkable resilience. The market seemed to shrug off the bad news, almost as if it had anticipated it. Some analysts attributed this calmness to a phenomenon known as bad news is good news. This paradoxical thinking suggested that negative economic indicators might actually lead to positive market outcomes. The logic was counterintuitive, yet compelling. In essence, bad news about inflation could signal that the Federal Reserve might soon change its course. Higher than expected inflation in this twisted equation could be interpreted as a sign that the Fed was nearing the end of its rate hiking cycle. Investors speculated that the central bank might pivot to a more accommodative stance. The thinking was that the Fed, having witnessed the stubborn nature of inflation, would have no choice but to ease up on its aggressive monetary tightening. This potential shift in policy was enough to keep the market buoyant. This anticipation of a dovish pivot by the Fed seemed to be trumping the negative implications of the CPI data. Investors were cautiously optimistic, hoping that the worst of the rate hikes might be behind them, and that a more favorable economic environment was on the horizon. Section 5. The bigger picture factors at play. The market's resilience wasn't solely due to speculation about the Fed's next move. Investors were also closely watching other economic indicators and global events that could influence market dynamics. Several other factors were at play, contributing to the cautiously optimistic sentiment. These included the performance of key sectors, geopolitical developments, and technological advancements. The labor market remained remarkably robust. Job creation continued at a steady pace, providing a solid foundation for economic stability. Unemployment was hovering near historic lows, which was a positive sign for the overall health of the economy. And wages, while not keeping pace with inflation, were still rising. This gradual increase in income helped to sustain consumer confidence. This indicated a degree of underlying strength in the economy, giving investors some comfort. The steady flow of income reassured many that the economic fundamentals were still sound. Consumer spending, the lifeblood of the U.S. economy, had also held up better than expected. Retail sales figures showed that people were still willing to spend on both essentials and non-essentials. Despite rising prices, Americans continued to open their wallets, driven by a combination of pent-up demand and a strong labor market. Fueled by pent-up demand and a strong labor market, consumer activity remained a key driver of economic growth. Furthermore, corporate earnings season had been relatively positive. Many companies reported better than expected results, which boosted investor confidence. While some companies were feeling the pinch of inflation and slowing growth, they were adapting by cutting costs and finding new revenue streams. Many had managed to navigate the challenging environment, reporting decent profits. This adaptability and resilience were key factors in maintaining a positive market outlook. The market's stoic reaction to the CPI report could be interpreted as a vote of confidence in the Federal Reserve. Investors, it seemed, were betting that the Fed had the situation under control, that it would be able to engineer a soft landing for the economy, taming inflation without causing a recession. This confidence, however, was not without its skeptics. Some analysts warned that the market was being too complacent, that it was underestimating the stickiness of inflation and the risks of a policy misstep by the Fed. The Fed, for its part, continued to send mixed signals. While acknowledging the progress made in bringing down inflation, it also emphasized the need to remain vigilant and data-dependent. The path ahead remained uncertain, a tightrope walk with high stakes. The market's calm facade masked a deeper truth. Uncertainty reigned supreme. The economic outlook remained murky, clouded by a complex interplay of factors, both domestic and global. The war in Ukraine continued to disrupt supply chains and fuel geopolitical tensions. China's economic slowdown posed risks to global growth. Climate change added another layer of complexity, with extreme weather events threatening to disrupt agriculture, energy production, and global trade. Investors, faced with this confluence of uncertainties, were left to grapple with a difficult question. Was the market's resilience a sign of underlying strength or a prelude to a painful correction? In these turbulent times, staying informed is more crucial than ever. The financial markets are complex, influenced by a myriad of factors, both rational and irrational. What seems like a paradox today could be tomorrow's headline. Don't be swayed by the whims of the market or the pronouncements of self-proclaimed experts. Do your own research, consult with trusted financial advisors, and stay abreast of the latest economic developments. Knowledge is power, especially in the world of finance. By staying informed, you can make more informed investment decisions, mitigate risks, and navigate the choppy waters of the market with greater confidence. The market's reaction, or lack thereof, to the latest CPI report is a stark reminder that we are living in extraordinary times. The old rules no longer apply, and the future remains unwritten. This is not a time for complacency. This is a time for vigilance, for curiosity, for a deep understanding of the forces shaping our economic landscape. Stay informed, stay engaged, and stay ahead of the curve. Your financial well-being may depend on it.